You are listening to Keystone Stock Talk Podcast, episode 71. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week in our Your Stock Our Take segment, we take a look at MTY Food Group Inc., symbol MTY on the TSX, a quick service industry giant that produces strong cash flow and has produced strong gains for our clients over the past several years. A listener asked us our current take on the stock, which has recently been ranked a hold in our coverage. Our dog of the week is Canadian Premium Sand Inc., symbol CPS on the TSX Venture, an exploration stage company engaged in the silica sand industry. The stock is down 32% in the past week and 55% over the past 12 months. Finally, our star of the week is Cascades Inc., symbol CAS on the TSX, a leader in the recovery and manufacturing of packaging and tissue products. The stock is up 12% over the past week and 33% over the last month. We discuss the current valuations and see if it may be a long-term opportunity. Let's get right into the show. I'd like to welcome my co-host here, Mr. Aaron Dunn. How are you doing?
I'm doing well, Ryan. How are you today?
Rather busy in the throes of putting together a breakthrough turnaround report for our Canadian small cap or Canadian growth stock related clients. That should be out over the next month.
So why don't you explain what is a breakthrough stock?
A breakthrough stock would essentially be, and we're talking about a company who has been progressing well towards profitability and has broken through into profitability in the last several quarters. It may be one quarter, typically it's a couple quarters or more, but a company who's been growing revenues, reducing losses, increasing cash flow, and has broken through into positive cash flow or profitability in the last several quarters. And it is a company that we think can continue to grow that cash flow and continue to produce strong cash flow going forward, reducing its multiples and offering good value over the long term. The turnaround type companies would be a company who has been profitable in the past, has gone through a period for a variety of reasons of lagging profitability or a period where it's lost money, and is looking to turn around and has turned around its operations into a more profitable state at present that we think is more sustainable going forward. So those are two of the companies that, or the type or profile of companies that can make it into that report.
So it sounds like this is the higher end of the risk spectrum, so riskier than what Keystone would normally look at, but obviously higher return potential as well.
Yeah, I mean, it's a great point to point that out. Often, and this research that goes into and the companies that go into this report come from us looking at all companies in Canada twice a year. It actually comes as a derivative from the Cash Rich report that we do twice a year for clients as well. These are stocks that we pull out when we're doing that research of all 3,200 companies in the Canadian market. These companies have, for various reasons, potential for our clients. They rank on the higher end because of the fact they're just breaking into profitability. They don't have that track record of profitability, but we highlight them for clients, and often they can make their way into our discovery portfolio, which are stocks we're doing discovery type research on that have a higher level of risk, but the higher potential for long-term outperformance in the market. You can often find maybe a mispriced security here when there's no analysts following them. They've just broken through into profitability. If they can continue that going forward, you're often getting in early before much of the market is getting in. So you have that opportunity. But certainly it comes with a higher risk than most of the companies that we typically look at.
Right. And so you do this every year, a breakthrough report, and generally, I suppose subscribers, clients can expect some individual stock recommendations out of that as well.
Yeah, and it looks that way again this time. There's about 12 to 15 that will be highlighted in the report specifically. It looks like, I have management interviews that we've started and will continue over the next couple of weeks. It looks like right now it's tracking towards 1 to 3 new recommendations coming out of it as well. You can't guarantee that. We'll see how the management interviews go, but there's a couple stocks that tend to stand out from this list. These companies, while they're on the higher end of risk for our coverage, they're heads and tails typically above the typical stock you find on the TSX or TSX Venture in terms of companies. Generally speaking, they still would be well ahead of most companies in terms of meeting our criteria. But, they have a little bit higher risk because they don't have that track record that we love to see in a company as well in terms of profitability.
Well, I look forward to seeing what you come up with.
I know you do, Aaron Dunn. I know you do. And you'll be looking through that you'll be waiting for that with bated breath, won't you?
I will.
Okay, good. We saw that cannabis stocks, we just wanted to touch on this, the first quarter earnings this year, it's really been, I think I saw an article saying it's been a quarter to forget for cannabis stocks. Canadian pot stocks were among the biggest laggards in the second quarter of the year for a myriad of reasons, I think, ranging from softer than expected sales, supply chain issues. All of these have hit the sector hard. I've seen analysts saying higher valuations that people are paying for these stocks. They'd expect high growth and strong revenues. For us, we'd expect profitability. It's not there yet. But when that doesn't come to pass, some of these stocks have been sold off. And if you look in the second quarter, a company like Canatrust Holdings, for example, traded down over 35% in the second quarter alone. Other notable names, including Afria and Hexo Corp, fell 26 and 21% respectively. Names like Aurora, Kronos, and Canopy were also decliners in the quarter. So some of the biggest names all declined in this past quarter. For me, the sector continues to be news-driven rather than cash flow-driven, which is often difficult to quantify and value and leads to wild fluctuations in valuations or the value that the market puts on the stock in the near term. I've seen analysts point to, and I would agree to this to a degree, systemic issues in the Canadian cannabis industry, including continued bottlenecks in distributing legal pot to provincial regulators, a stunted rollout of physical retail stores in some of the country's biggest markets, such as Ontario, BC, and Alberta, as well as delays packaging and shipping cannabis. These are certainly negatives in the near term for the segment, but our biggest concerns include the fact that there's not a single company, and Aaron, you talked about this in a video last week in this hot segment, that is operationally profitable. And there's also the potential productive capacity right now that exceeds demand in the mid and long term. So those are two negatives that we see for this sector that should shake out over time, but they don't lead us to seeing any real solid value in the sector right now.
Yeah, absolutely. I just put out the video last week, and we were looking at the supply dynamics in the cannabis space, the likelihood of an oversupply situation in the next 2 to 3 years. This is actually something similar to what's happening in Washington State right now, where they're oversupplied essentially, and the government down there is looking at ways to curtail production to reduce the supply. But certainly profitability has been a major concern, and that was the highlight of the quarterly period for the industry.
Indeed, and we'll continue to monitor it, and we'd like to see a company, stick out its head and become significantly profitable in the near term in that sector, and then we would really dig into the numbers. But until that happens, it's not going to meet our criteria. We don't have a single stock in there that meets our criteria in terms of current cash flow. So now let's get into Your Stock, Our Take segment. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. We're going to look at the first company, MTY Foods Inc. The question comes in from Stevie V via email. Asks about this stock. Know it's been in our coverage in the past and wanted to know our current take on MTY Foods. Aaron, I'm going to let you handle that.
Sure. MTY Food Group, symbol MTY, trading at about $65 right now, has a market capitalization of about 1.65 million, or billion, sorry, 1.65 billion. So what they are is they're a franchisor operating in the quick service industry. So they own a group of banners in the quick service restaurant industry, and there's quite a few. I'll just mention a couple of them: a Big Smoke Burger, Just Jugo Juice, Maku Walk, Muffin Plus, Valentine, Van Hoyt, Sushi Man, and several more. But this has been a growth by acquisition company. Last year in 2018, they completed 5 acquisitions for a total expenditure of $325 million, adding 702 locations to their network. And this year to date, in 2019, MTY has announced 4 acquisitions, including a merger with Papa Murphy's, which alone is valued at 190 million US, or about 250 million Canadian. So at the end of Q1, their most recent quarter, they had a network of just under 6,000 locations throughout North America and internationally, 5,941 to be exact. The geographic split is fairly even between Canada and the United States, 46% US, 45% Canada, 9% international. And then subsequent to the acquisition or merger of Papa Murphy, the geographic split will change. The percentage in the US will be 56% and 36% in Canada. So more exposure to the US market. And they just put out their Q1 results. Well, on April 11th, the Q1 results were released. Very strong performance. Overall, revenue increased 28% to 687 million. Same-store sales were down 1.4% compared to the same quarter last year. Now, in Canada, the same-store sales were up marginally, and that makes this the 6th consecutive quarter of positive same-store growth. But in the United States, they saw a decline, which they attribute to adverse weather conditions. But same-store sales has been an issue for the company. They've not been able to grow same-store sales overall for several years. EBITDA during the quarter increased 47%, and normalized or adjusted EPS was up 44% to 59 cents. But very, very acquisitive company. All of the growth that they've been generating over the years has generally been coming from acquisitions. So over the last 3 years, revenue's grown at an annual rate of averaging 44%. Adjusted EPS, or earnings per share, has averaged 43% growth per year. So very strong growth overall in the business. And they're trading about 15 times adjusted earnings right now. So certainly a reasonable valuation. Our take on the company, we're very impressed with the acquisition strategy. We're very impressed with the growth that they've generated. The merger with Papa Murphy's has the potential to be very significant to financial performance over the next 1 to 2 years. We expect that they are going to continue to grow the company by acquisition and do that very aggressively. The balance sheet is healthy. The valuation is attractive relative to growth, 15 times earnings, adjusted earnings. They do pay a small dividend, but they're only yielding about 1%, so barely a dividend stock. The big concern that we have, and this is an issue in the restaurant industry, is that investors, the market is always expecting same-store sales growth. That's one of the most important metrics when it comes to the restaurant business is same-store sales growth. And that's not something that MTY has been able to produce for several years. So certainly a strong performer overall, but we would like to see those same-store numbers go positive, even just marginally positive. And if that were to happen, there'd be very significant upside going forward.
Yeah, I would agree. I mean, it is the company. The growth by acquisition strategy it's a tough one. I mean, companies do, if they can navigate it successfully, it can be a very profitable strategy long term, but it is a tough strategy to execute. It's hard to bet against MTY because they have executed this strategy successfully over the long term. Even though same-store sales have been challenged, cash flow on a per-share basis keeps increasing over time because of the way they're able to execute that strategy. So certainly Papa Murphy's is a bit of a turnaround type acquisition. It's a large acquisition for the company. If they can turn that business around, increase profitability there, and we see same-store sales increases, the price that it's trading at relative to cash flow is reasonable. So it's certainly a company that we continue to monitor and have a hold on right now in our coverage.
And I'll note as well that the stock is up about 30% approximately over the last year. So they have been doing well in the market, but a lot of volatility along the way too. So it's
without a doubt.
Yeah, there's been a lot of ups and downs in the share price.
Yeah, and I think that, like Aaron said, many analysts look at the company and want same-store sales growth because it's a typical metric that you use to value these type of companies, and you don't always see this. You're seeing it in Canada now, but not in the U.S. for the company. The free cash flow, the cash flow generation here is something also to focus on, and that's not always focused on when analysts look at these companies because you're looking for growth in the same-store sales if you don't see that. But the way they've been able to execute on an acquisition basis does produce cash flow and does produce good returns over time. It's just a different way to look at the business maybe than some other analysts would look at it. So I think if you look at it as a cash flow generator, it probably outperforms and continues to outperform over time. Now we're going to look at our weekly dog. From our Stars and Dogs segment, it's time for this week's dog. That is Canadian Premium Sand Inc., CPS, on the TSX Venture. Currently trades around 75 cents, market cap of around 16 million. The stock is down 32% in the past week and 55% over the past 12 months. The stock actually peaked on August 8th around $3.53 and is down around 80% over 10 months since that time. Now, what does the company do? They are based in Canada, engaged in the silica sand industry. To be clear, Canadian Premium Sand remains an exploration stage company that is in the process of seeking all the necessary third-party approvals and external funding to design, construct, commission staff, and operate completely enclosed year-round operational silica sand extraction and processing facility. Now, we always look at what is driving the stock. What is driving the stock lower? Well, for a news-driven exploration company such as this, it's always tough question as there's no underlying cash flow to value the business, so the stock is trading on quote-unquote future potential, which is always highly speculative. So what has changed within the business over the past 12 months to cut the share price in half? We would argue that really nothing of significance has, other than the fact that it probably should not have been at those loftier levels over the past year to begin with. We do note the COO recently resigned, but I'm not sure if that has a massive impact on the business. Financially, the company's not generating any current revenue. The net loss in the last quarter, Q2 2019, was $3.5 million. So this is a company that will likely need to be funded further in the near term. So our take on it, Canadian Premium Sand is simply, at this stage, an exploration company going through the process to get a project approved and secure some speculative funding. The company, again, has no current revenues, and the losses continue to be significant. In the last year, the company has more than doubled its shares outstanding after we adjust for a 15-for-1 reverse share consolidation. One day, its sand project may be operational, but we are nowhere near that point at this stage, and it will likely need funding, like we said, just to stay operational in the near term. It is purely speculative, does not meet Keystone's minimum criteria for investment. The significant share losses it has incurred over the last week and last year place it as our dog of the week.
No profit, no revenue, not really much to say on that.
No, there's not a lot to dig into. We had somebody ask actually a question on this company for a your stock, our take. There's not even really enough to dig into fundamentally to have a your stock, our take on it. That's about as far as I can go, and it just ends up ranking as our dog of the week.
But there are hundreds of companies like that are trading on the market, mostly the TSX Venture. So it does more or less provide a good framework for how to approach a company like that, which is don't invest. Don't invest in companies that don't even have revenue. They haven't proven out any type of business model. And I understand in the junior mining space that is not really most of the companies aren't necessarily intending to produce and generate revenue. They're intending to build an asset and sell it. But very, very, very few actually are able to do that and provide value to their shareholders long term.
Yeah, and if you want to have an investment or a stock that's investment grade, you have to start off with a minimum criteria of the company at least generating some sort of cash flow. These businesses are nowhere near that stage. We're not saying that management is not well intended or anything of the sort. It's just it doesn't meet our criteria, and it shouldn't meet any investor's criteria as an investment grade investment. You want to speculate on it, throw some play money on it, that's up to you. It doesn't fit our criteria, and we would not recommend it to our clients. So we're going to look at our star of the week. From our Stars and Dogs segment, it's time for this week's Star. It's Cascades Inc., symbol CAS on the TSX. Aaron, I'd like you to take that one.
Absolutely. So Cascade trading at just a little under $12 per share, $11.71 last time I looked, a market cap of just over $1 billion. So the company, the reason it's a star this week is their share price is up about 10% over the last week and nearly 30% over the last month. And what does the company do? Well, they're in the business of producing and marketing packaging and tissue products composed mostly of recycled fibers. So the company is organized into four main business segments. These include the container board segment, box board segment in Europe, specialty products, and tissue papers. So they're an international company with operations through Canada, the United States, Italy, and other companies as well. And their customer base mostly includes food processing companies, housing industry, maintenance industry, and other areas as well. So what is driving the stock? Well, it started with the release of their Q1 results on May 9th. The share price was up 21% after the release of the results. So obviously investors were happy with that. Following that, more recently on June 28th, Cascades announced that it won a bid at auction for the acquisition of a company called Orchid Paper Products that is going through bankruptcy. So Cascade will acquire the assets for cash consideration of about $207 million US. And these acquired assets are expected to generate annual EBITDA, or earnings before interest, taxes, depreciation, and amortization, of around $45 million beginning in 2021. And this implies an acquisition multiple of approximately 5 times. So looking at the results, the Q1 results, which were released in May, Cascade reported revenue of $1.23 billion, up 12% compared to the previous year. Adjusted EBITDA was $239 million, up 15% on a per-share basis. Adjusted EBITDA of $2.49, which was up 18% year over year. And adjusted earnings were 14 cents in Q1, which is compared to 13 cents in the same period of the previous year. So marginal growth in adjusted earnings per share. So looking at the company, it's trading at a price to earnings multiple right now about 14 times adjusted earnings, enterprise value to EBITDA of about 3.5 times. So low multiple relative to EBITDA. In management's outlook, they say they are expecting near-term results to improve both sequentially quarter over quarter and on a year over year basis. So Cascade has built some good share price momentum over the last month here. After the release of its Q1 results and the acquisition announcement. We actually did have coverage on this company in our income stock research several years ago. We ended up selling out our position at a big gain. One thing that I will say that I know about Cascades from covering it in the past is that it is a fairly complicated business. It does have a lot of moving parts. The company also has a fairly significant debt load. The valuation is attractive, but we would like to see a continued reduction in the level of debt. Nevertheless, the recent flow of positive news and the strong share price performance over the last month make this company our star of the week.
Well, thanks for that summary. I think I think it's a company that you continue to monitor. Our income clients made a significant profit on that in the past, and we'll continue to monitor the company going forward, particularly in light of the recent acquisition, the asset acquisition there, to see if that continues to strengthen the cash flow going forward and potentially help them at some point pay off some of that debt. Now, I think that does it for our show this week. I'd like to thank Aaron for co-hosting with me.
Thank you, Ryan.
And encourage you to continue to keep your questions coming into our Your Stock, Our Take segment. We'll endeavor to answer those each week. We keep getting more and more coming in. And again, I'd like to wish all our listeners out there profitable investing.
Profitable investing.